Hello friends, today's topic very important, capital gains tax on stocks to increase. There is a question mark. Government likely to revamp capital gains tax in next budget to boost revenue, a report says. The capital gains tax regime is complicated, clean up long overdue, Revenue Secretary Tarun Bajaj. Union Revenue Secretary Mr. Tarun Bajaj has announced that the capital gain rule for various assets are complicated in India and there is a need to simplify it. He said the government has received several proposals to simplify the capital gains tax structure and the government is discussing what changes need to be implemented in the budget for 2023-24 on 1st February. One of the proposals is to increase the tax on long-term capital gains from stock markets in the next budget 2023. Currently, below is the tax on stock market gains. Category short-term capital gains, profit from stock markets made within 1 year, that also includes mutual funds, 15%. Long-term capital gains, profit from stock markets which is booked after 1 year, 10% after 1 lakh profit. Now, taxation of gains on property and bank FD interest. Real estate less than 2 years is termed as short term as per income tax slabs 10, 20 or 30%. Real estate more than 2 years 20% with benefit of indexation. Bank FD interest anytime it comes as per income tax slab 10, 20 or 30%. Until April 2019, there was no capital gains tax on long-term holdings in stock markets. Currently, long-term capital gains on stocks held for more than 1 year is taxed at 10% on profits above threshold of 1 lakh. If you notice, the tax is higher for capital gains on real estate and gold investments. Also, the current period to classify as long-term, short-term is different for different assets such as stocks, real estate and gold. According to the proposal to increase taxes and simplify taxes, the government philosophy is that passive income earned from long-term holding in stock market should not be taxed at a lower rate. The government has observed that long-term capital gains are taxed in many countries at 25 to 30% range or as per the income tax slabs. It almost looks like government assumes that the risk taken by a FD holder and a stock market investor is the same. FD is risk-free and gives guaranteed interest and hence taxed as per income tax slab. Stock market investing is more like a business which involves taking sufficient risk and there is a high chance of loss, hence imposing higher taxes illogical. As per the latest available statistics of the Income Tax Department for the year 2021, only around 6 crore people have filed their IT returns. As per statistics, only 3% of the Indians earn income of more than 5 lakhs per annum, which is looking like a joke, and only around 15 lakh individual taxpayers have disclosed income above rupees 10 lakhs. So, a very small percentage of the population pay income taxes in India. In order to increase the tax revenue for the government, they are trying to increase tax on stock market gains to fund various welfare schemes. Only around 5 to 6% of the Indian population invest in Indian stock markets, hence this is an easy target group. Government may be feeling that such a small number of people will not be able to protest if taxes are increased. The government is trying new ways to collect tax or increase revenue to fund welfare schemes. It has been selling stake in various public sector companies and also monetizing assets of various ministries such as telecom, petroleum, railways. There are several other ways to increase tax revenue. This is our opinion. Number one, by ensuring stricter tax compliances for income tax for business and GST. Two, identify wealthy agriculturists and introduce tax. Three, identify tax evaders who spend on luxury items but don't pay income tax, etc. However, Targeting all these categories of people will result in losing popularity among the general public and hence may result in losing the future election. So, such actions are done with a political angle in mind rather than actually improving the Indian economy and spreading the burden of taxation among large number of people rather than only 1% of the entire population. Anyway, let us see if this proposal is accepted by government in the coming union budget or any time subsequently. Till then, things will go on as usual. Finally, at the end of the video, here is a question as a survey. What will you do if in the future government increases the tax on stock market gains? There are three choices. Continue to invest in stocks, type A, reduce investing in stocks, type B, and stop investing in stocks, type C. If you are not the member of Stock Market Academy, this is the time to subscribe, press the bell icon, send this video to all your friends, and finally, if the video is good, press the like button. Thank you for watching. My name is Dr. Bharath Chandra. Bye bye. All the best.